So the start of 2020, I mean, it kicked off with a shift that I don't think anyone in the energy world really saw coming.
Not at all. The capture of Nicolás Maduro on January 3rd, it just changed everything overnight.
And the U.S. administration moved so fast, immediately they're in there trying to overhaul Venezuela's entire energy infrastructure. It just completely flipped the script.
It really did. And it was a moment of, intense geopolitical volatility. The market's first reaction was exactly what you'd expect, panic.
Right. But the fascinating thing here, and what our sources are saying, is that the real story isn't the immediate crisis. It's not some sudden oil spikes.
No, not at all. It's something much more complex and I think much more enduring.
Exactly. And that's what we need to unpack. This thing we're calling the Venezuelan Paradox.
Mhm.
Because the numbers, they're just staggering. Venezuela is sitting on the world's largest proven oil reserves. We're talking over 303 billion barrels.
And just to put that in perspective for you, that's more than Saudi Arabia.
It's a mind-boggling amount of potential. But its immediate return to the market creates this massive tug of war, doesn't it?
It really does. Between that enormous potential and the decayed reality of its infrastructure on the ground.
And that's our mission for this deep dive.
Right. We've synthesized the sources, the energy forecasts, the policy papers, all the market analysis, and they all point to the same thing.
Which is that the impact is less about a shock.
And much more about a fundamental reordering of the global energy map. So we'll be looking at the painfully slow production timeline, the really complex new U.S. policy controls, and, why this is actually, for the most part, a good thing for consumers.
Okay, let's jump right into the immediate market reaction then. The news breaks on January 3rd, and we see that classic volatility.
Oh, absolutely. Traders immediately started pricing in all this geopolitical risk.
And that created this, what they call a short squeeze, right? Pushing prices up towards $60 a barrel.
Exactly. But maybe we should quickly explain what a short squeeze actually is in this context.
Yeah, good idea. Because it sounds like financial jargon, but it's key here.
Well, it happens because a lot of traders had been shorting oil. They were basically betting that prices would fall.
Or at least stay flat.
Or stay flat. And when the Maduro news hit, the fear of, supply disruption or even war, it caused this panic.
Yeah.
All those traders suddenly had to rush to buy back their contracts to cover their bets.
And that rush to buy is what forces the price up?
Precisely. It's driven by fear in the financial markets, not by a single barrel of oil actually disappearing from the supply.
I see. So the price spike was just trading mechanics, not fundamentals.
And that's why it was so incredibly short-lived. Because if you look at the bigger picture, the market fundamentals are just overwhelmingly bearish right now.
The market is already oversaturated.
Totally oversaturated.
Yeah.
You've got robust U.S. shale production, and you have these new super efficient offshore players like Guyana just pouring high-quality oil onto the market. That existing supply glut basically put a hard ceiling on any shock.
So, and this seems so counterintuitive, Venezuela's reentry isn't a catalyst for higher prices. It's actually a bearish weight. It's pushing prices down.
It is. The return of these barrels, or even just the promise of their return, adds this persistent downward pressure on the existing supply.
Which contributes to the glut.
Exactly. And that's why you see forecasters from the IEA and the big banks saying Brent crude will probably average around, $58 a barrel for the rest of 2026.
That signals stability, not crisis.
Right.
And we shouldn't forget, some barrels are hitting the market right now. The Department of Energy is already moving to release between 30 and 50 million barrels of that sanctioned oil that was just sitting in floating storage.
Yeah, mostly off the coast. That's an immediate injection into the glut, a quick shot of stability.
But it's just the appetizer, right?
Just the appetizer. The real complexity begins when you look at the production roadmap. The starting point is just so low.
Unbelievably low. As of right now, early 2026, Venezuelan production is somewhere between 750,000 and maybe 960,000 barrels per day.
Which is just a tiny fraction of its historical peak.
And getting back there, well, we can't just flip a switch. The timeline is frustratingly slow. By the end of this year, 2026, the country could realistically get to 1.1, maybe 1.2 million barrels per day.
But that's a big if.
A huge if. That's only if the U.S. allows for those selective sanctions rollbacks for things like infrastructure repair.
That conditionality is everything. Then you look out to the medium term, say 2027, 2028, with some serious, sustained investment from global firms.
You mean like Chevron, the ones who never really left?
Exactly. With their help, output might hit 1.4 million barrels per day. It's progress, but it's still nowhere near the 3 million they used to produce.
I just don't think people grasp the sheer scale of the investment needed. To even think about reaching that historical high of over 3 million barrels a day, the sources all estimate it would require over $100 billion. dollars.
100 billion, and just as critically, at least a decade of stable governance.
That $100 billion figure, I mean, you have to really let that sink in.
You do. Think about it. That's enough money to build a massive high-speed rail network or fund NASA for years. It's an eye-watering sum, and it's needed just to reverse 2 decades of decay.
And that really puts the 1.4 million barrel goal into perspective, doesn't it? It shows just how much work is ahead.
And it raises the question, who is going to front that 100 billion? Which leads us directly to the U.S. policy pivot.
Right. Because the U.S. administration knew that investment would be slow to come, so they didn't just throw the doors open. They moved to assert massive control.
And that's the genius, or maybe the ruthlessness, of their strategy. The centerpiece, which they unveiled right after the capture, is this strict quarantine on all oil movements. They're calling it the approved channels policy.
And the sources make it crystal clear. The only oil allowed to leave Venezuela has to flow through these U.S.-approved channels.
Washington is basically taking the reins of the country's entire energy grid.
And they are backing that up with force. We're already seeing the U.S. Coast Guard and the DOJ seizing dark fleet tankers in the Caribbean.
Right, the ones trying to move oil outside these new channels. It's a very clear signal.
But it's not just physical control, it's financial too. A complete purse strings strategy.
Yeah, this part is critical. The revenue from oil sales, it doesn't go back into some shady state account. It gets deposited into U.S.-controlled escrow accounts at major global banks.
So the U.S. is the accountant and the bank manager, and the funds are dispersed at the discretion of the U.S. government to support American and Venezuelan populations.
Which is really political leverage, isn't it?
It's almost entirely leverage. That control mechanism means that money for reconstruction, for maintenance, it can all be throttled or stopped instantly if the new government steps out of line.
It's far more powerful than any sanction ever was.
And the conditions for any further sanctions relief are incredibly harsh. Venezuela has to sever all economic ties with China, Russia, Iran, and Cuba.
A massive demand. It forces them to pick a side overnight.
Absolutely. And we have to emphasize, sanctions have not been broadly lifted. The Treasury is only issuing very specific private waivers and licenses.
And they're tightly controlled. What's allowed in is very specific. Oil field equipment, parts, services, anything needed to fix the decay in the Orinoco Belt.
Now, why do we keep mentioning the Orinoco Belt? For anyone who might not be familiar, what makes that oil so uniquely challenging?
That's a great question. The Orinoco Belt is where all this extra heavy crude is. It's not like the light sweet stuff you get in Texas.
It's thick, like tar.
Exactly. It's thick, tarry, sulfurous. We call it sour crude. You can't really pump it or transport it efficiently without treating it first.
Which is why the U.S. policy specifically allows for the shipment of diluents.
The thinners, yes. Without those diluents, that $100 billion worth of oil just stays locked underground like cement.
So those diluents are the key to the whole thing. And importantly, any private trading firms that get these waivers have to agree to sell the oil only to U.S.-based buyers.
And that one constraint, that single rule, perfectly sets up this whole geopolitical reordering.
It really does, because for years, Venezuela's heavy sour crude was the lifeblood of China's independent teapot refineries.
Sold at steep discounts.
And now that whole established trade flow is just ending.
Yeah.
Abruptly.
And those teapot refineries, they were built for this stuff. They're smaller, independent operations that flourished because they could process the cheap, heavy, sanctioned crude from Venezuela or Iran.
Now their main feedstock is gone.
It's on. They're forced into a much more competitive market almost overnight.
And the reason the U.S. Gulf Coast wins here is basically historical infrastructure.
It's almost like infrastructure déjà vu. Those U.S. refiners on the Gulf Coast were literally built decades ago specifically to process this exact kind of heavy, sour Venezuelan crude. They are perfectly positioned to just reclaim those volumes.
So this creates a ripple effect. The U.S. is sucking up the Venezuelan supply.
Which means the Chinese refineries have to pivot. They'll likely go after Russian Urals or Iranian heavy.
Which intensifies competition for those other sanctioned grades. It's a profound shift in global supply lines.
Exactly right. Yeah. And that brings us to the reaction from the old guard, from the global cartel. What does OPEC Plus think about all this?
Right. Section 5, the OPEC Plus Balancing Act. Venezuela is a founding member of OPEC, but its production has been so low for so long that it's been, a silent partner.
They haven't had much of a say for years.
Not at all. So in direct response to the events of January 3rd, OPEC plus Allied, led by Saudi Arabia and Russia, immediately paused their planned output hikes for the first quarter of 2026.
That sounds defensive. What are they actually afraid of? It's not just a few extra barrels.
No, it's the fear of a perfect storm. They're worried about a potential global economic slowdown hitting at the exact same time as a surge in Venezuelan exports.
Okay.
So if Venezuela actually gets its act together and hits, say, 1.4 million barrels per day by 2028, the fear inside OPEC Plus is that prices could slide into the 40s.
And they would have to maintain even deeper cuts just to protect that price floor.
Exactly. And this highlights the major policy tension facing the U.S. administration right now. It's the most important conflict in this whole deep dive.
It is. Because on one hand, the U.S. needs massive private investment to make this work. The administration is meeting with executives from ExxonMobil, Chevron.
Pitching that huge $60 to $100 billion redevelopment plan?
They're selling a decade-long investment opportunity. But on the other hand, the sources all confirm the stated U.S. policy goal is to drive global oil prices down to $50 a barrel.
And there it is, the profitability gap. The administration wants investment, but it also wants cheap gas for voters.
And this is where the physics of the oil comes back in. This heavy Venezuelan crude is expensive to get out of the ground and process, especially after all this neglect.
The break-even cost is high.
Very high. Analysts say the break-even cost for new projects is well into the 50s. Some even say closer to $60 a barrel to justify the massive upfront capital.
So if the U.S. policy goal is a $50 a barrel ceiling,
The profitability needed to justify that $100 billion price tag just vanishes. It's gone.
so the U.S. is asking private companies to make a massive, decades-long bet on a project whose profit margins the government is simultaneously promising to eliminate.
It's an impossible tightrope walk. The oil majors are asking, why should we spend $10 billion today to get oil in 2030 if the U.S. government is going to make sure we barely break even?
That tension is going to define the success or failure of this whole project.
It absolutely will.
So after all that, what does this all mean for the big picture? What's the final takeaway?
I think the Venezuelan effect in 2026 is fundamentally a reordering of the global energy map. For the first time in a generation, the Western Hemisphere energy powerhouse, the U.S., Canada, Guyana, and now potentially Venezuela, looks like a unified bloc.
A bloc with enough weight to challenge the pricing power of Middle East and Russia.
Exactly. It shifts the entire center of gravity for oil westward, away from the traditional OPEC plus centers.
And for you, the listener, the consumer, this is actually pretty good news.
Generally, yes.
Because Venezuela holds all that upside supply risk, that enormous 303 billion barrel potential, its presence acts as a powerful low ceiling for global oil prices.
We might not see a huge sudden drop at the pump, but the risk of those massive price spikes is heavily mitigated.
More stability, which helps everyone budget.
And that brings us right back to that core tension, which is something for you to think about. We've established the U.S. needs private investment to the tune of $100 billion, and that requires profitability.
But their stated goal is a $50 a barrel price ceiling, which makes that investment uneconomical.
So the question to mull over is this: how long can the U.S. truly balance those two conflicting objectives, encouraging massive private spending while actively working to reduce the profit margins of that very same spending? It's a high-stakes tightrope walk. And the outcome will dictate whether Venezuela returns as a global powerhouse or just remains a source of short-term geopolitical leverage.
Factoring can meet the cash needs of energy companies looking to expand. Contact Chris at Versant Funding to learn if your energy client is a factoring fit.
The events of January 3rd, 2026, the capture of Nicolás Maduro, and then this subsequent and really swift decision by the U.S. administration to overhaul Venezuela's energy infrastructure, it represents, arguably the most significant geopolitical shift in global oil market dynamics we've seen this century. And this dramatic reversal immediately brings into sharp relief what we're calling the Venezuelan oil paradox. We're talking about a nation that holds 303 billion barrels of proven reserves, the largest in the world, a potential powerhouse that right now produces less than 1 million barrels a day because of just decades of decay. And to get back to its potential, say 3 million barrels a day, the sector needs a colossal infusion of cash, estimated somewhere between 60 and $100 billion over the next decade.
And the paradox, of course, is that this massive investment requirement is running up against an explicit, a stated U.S. policy goal to drive global crude prices down to around $50 a barrel.
Exactly. So that tension really frames our central question today. Is the current U.S. policy, with its strict trade controls, its flow redirection, and price suppression, is it a necessary stabilizing measure? Is it the only viable path to guarantee a long-term recovery and ensure the revenues actually fund the rebuild? Or does this policy fundamentally undermine the very investment required to ever reach Venezuela's potential? Does it create a kind of self-defeating financial gap?
And I'll be arguing that by prioritizing that immediate geopolitical leverage and, consumer price relief, the policy introduces a critical and I think irreconcilable profitability gap that jeopardizes the entire decade-long capital commitment needed for this rebuild.
And I'm going to contend that this initial period of stringent control is the indispensable prerequisite for securing that long-term private capital. That stability and strategic advantage, they have to come first. My position really rests on the necessity of immediate non-negotiable control. The U.S. administration's response, it includes an immediate quarantine on oil movements, the establishment of U.S.-approved supply channels, and the strict use of U.S.-controlled escrow accounts. And this is the only viable mechanism to ensure two things at the same time. First, that the $100 billion investment goal is even remotely plausible. And second, that the oil revenues are not immediately diverted or lost to the systemic corruption that defined the previous regime. We are not just talking about stability here. We're talking about a major global market reordering. Historically, Venezuelan heavy, sour crude, the kind you find in the massive Orinoco Belt, it was sold at these steep discounts, often through sanctions-evading networks. And a lot of it ended up in China's less specialized teapot refineries. Now that flow is being diverted back to its intended and, frankly, its most efficient destination, the U.S. Gulf Coast refiners.
And for good reason. Those specific U.S. facilities were explicitly engineered to handle that high sulfur content, that high viscosity of the heavy sour crude.
Precisely. This shift is a crucial geopolitical and logistical pivot. The U.S. is selectively rolling back sanctions, specifically licensing the import of parts, services, and necessary diluents. But the priority is infrastructure repair and secure revenue. We have to stabilize the operational flow and control the revenue stream before any multinational executive will sign off on a, $20 billion capital expenditure plan. Stability and controlled revenue streams are the prerequisites for securing the long game. Without that escrow account structure, that $100 billion goal is just a fantasy.
I approach this situation from the perspective of financial reality. And here, the administration has from day one really created an internal conflict for itself. While the geopolitical ambition is clear, control the revenue, redirect trade, the financial mechanism to actually execute the infrastructure plan is fundamentally undermined by that price target. The administration's stated policy goal of actively driving global crude prices down to $50 a barrel, well, it establishes a ceiling that creates an untenable profitability gap when you measure it against the sheer difficulty and the cost of extracting this specific resource. We know the private sector majors, ExxonMobil, Chevron, maybe others, they're the only ones capable of executing this monumental redevelopment plan. But extracting and upgrading heavy crude from the Orinoco Belt is a high-cost recovery. Even with modern efficiencies. The base cost of extraction, blending it with diluents, upgrading, transporting this heavy, sludgy crude, that can easily sit in the $40 to $45 a barrel range. That leaves a microscopic margin if the U.S. is simultaneously committed to driving the market to 50.
A margin which still exists, though.
But it's a non-viable margin when you factor in the required decade-long amortization of $100 billion in infrastructure spending. And on top of that, the global market is already well supplied. U.S. shale production is robust. Guyana is rapidly ramping up output. The return of even the medium-term goal, say 1.4 million barrels per day, acts as a powerful bearish weight on the market. This $58 a barrel forecasted environment is already the ceiling for a high-cost investment like this. The policy is actively trying to push it into the basement. The price goal is financially sabotaging the investment goal.
And that brings us squarely to the core conflict here, the financial imperative of a high price versus the strategic imperative of price leverage.
Exactly. If reaching that 3 million barrel per day target requires a decade of stable commitment and up to $100 billion, how do you logically convince a major oil executive to commit that capital when the U.S. government, the very entity guaranteeing the investment, is at the same time prioritizing a short-term political goal of $50 a barrel oil? You just cannot ignore the technical reality that Orinoco crude is fundamentally different from West Texas Intermediate. The cost of extracting, upgrading, and transporting this heavy crude creates a break-even point far above what the administration seems willing to tolerate.
I understand the skepticism. I do, regarding the return on capital. But I would frame the low price target not as a profit cap, but as a critical tool of negotiation and operational efficiency. This is more than just a simple political whim to please consumers. It's essential leverage applied against the private sector firms that are going to be involved in the rebuild. We have to remember the history of PDVSA. Over the past 20 years, contracts were notoriously padded, often by 20 to 40%, which just fed corruption and inefficiency. The low price target, that implicit threat of a low margin environment, it forces the private sector buy-in to be tied to absolute efficiency. It mandates the use of modern, non-corrupt procurement models, streamlining engineering and construction contracts to ensure a lean, fast rebuild and eliminate that historical inflation of costs.
That's a compelling argument for efficiency, I'll grant you. But it ignores the simple fact that private capital is mobile. If the risk-adjusted return in Venezuela, constrained by a $50 ceiling, is lower than development in the Permian Basin or offshore Guyana, the capital simply shifts. And furthermore, the long game, that $100 billion infusion, is dependent on predictable, long-term returns, not leverage. Meeting with these executives to pitch a massive redevelopment while actively signaling you intend to depress the global commodity price, that creates profound financial instability. It's the exact opposite of what you need for a decade-long commitment.
But that long-term commitment isn't necessary for the immediate stabilization. We're forgetting the short-term goal. The administration is immediately releasing 30 to 50 million barrels of seized storage oil for sale at market prices. That secured capital, controlled by the state through the escrow accounts, is enough to finance the initial ramp-up, moving production from 750,000 barrels a day toward that 1.1, 1.2 million short-term goal. That initial crucial stabilization is funded by seized assets. It's not dependent on private investment ROI at $50 a barrel. It gives us the breathing room to establish confidence.
Breathing room, yes, but confidence for the $100 billion only comes from demonstrating a path to profitability, not from leveraging seized funds. Confidence ultimately has to be built on financial reality, not strategic control.
Confidence is built upon strategic stability. And that pivots us to the crucial geopolitical conditionality attached to this entire policy framework. This is the insurance policy for the $100 billion. My core argument here really hinges on the durability of this geopolitical reordering. The U.S. policy demands that, as a condition for sanctions relief and operational support, Venezuela must sever all economic and energy ties with China, Russia, Iran, and Cuba. This is not optional. It is essential for Western energy security and leverage. This conditionality guarantees that the redirection of Venezuelan oil flowing exclusively through U.S. authorized channels, primarily to the U.S. Gulf Coast, is permanent. This acts cements a powerful Western Hemisphere energy bloc. You have the U.S., Canada, Guyana, and Venezuela, and that fundamentally shifts global leverage away from Middle Eastern and Russian suppliers. The flow control and the escrow accounts are the security deposit for the entire investment community.
I'm just not convinced by that line of reasoning, because while it delivers a desirable geopolitical outcome for Washington, it actively compounds the complexity and slows down the technical recovery that Venezuela so desperately needs. Look, we are talking about infrastructure that has been gutted by 2 decades of neglect. Forcing a complete, immediate severing of ties introduces immense logistical and technical hurdles. For example, China and Russia often provided necessary diluents, specialized equipment, crucial financing mechanisms when Western companies were prohibited from operating there. So if the stated goal is rapid stabilization and increased production, say reaching 1.4 million barrels per day by 2028, shouldn't the policy prioritize immediate infrastructure fixes and access to necessary equipment waivers over stringent, instantaneous ideological alignment? The decay of the Orinoco Belt's upgrading facilities, it's profound. Replacing that historical expertise in capital flow overnight is extremely difficult.
But the geopolitical conditionality doesn't slow the recovery. It enables that recovery by providing the necessary stability guarantees that the private sector requires. Western companies looking at that $100 billion figure are not going to move unless they have absolute, ironclad assurance that sanctioned countries who have a history of malign influence won't immediately step back in, disrupt operations, or siphon off the profits needed for the rebuild. The U.S. managed escrow accounts tied directly to the severing of those ties ensure revenue transparency and prevent political risk.
But the risk remains that you're prioritizing strategic goals over operational speed. The necessity of diluents for heavy crude extraction means you need a ready, reliable supplier. If you shut down the previous supply lines instantly, you introduce bottlenecks in the operational ramp-up. You're trading speed and technical simplicity for long-term political certainty. It's a gamble that infrastructure can be rebuilt fast enough to capitalize on the geopolitical advantage before market conditions change.
The policy accepts that short-term delay for a long-term guarantee. If the capital is secure and the market destination is certain, the U.S. Gulf Coast, then the technical hurdles, while substantial, they become mere logistical problems rather than existential political risks. The private sector can manage logistics. They cannot manage political instability tied to malign state actors.
And that political certainty, however strategically sound, must ultimately confront the realities of the current global market dynamics. The global supply situation is currently defined by a glut, with Brent prices projected by many analysts to hover around $58 a barrel throughout the first half of 2026. The source material shows that even the modest return of Venezuelan barrels acts as a significant bearish weight on the market, forcing OPEC Plus to already pause planned output hikes for the first quarter of 2026. This market dynamic creates a dangerous feedback loop. Low prices deter high-cost investment, which Venezuela absolutely is, and that leads to a slow ramp-up. A slow ramp-up keeps global stability tentative. If prices fall into the 40s, as OPEC publicly fears, the entire Venezuelan redevelopment project, which relies on high-cost extraction, it fails before it even gains momentum. You're putting this high-cost project on a tightrope over a very low-price floor.
You're putting this high-cost project on a tightrope over a very low-price floor. That's a compelling argument regarding the downside risk, but have you considered the opposite effect this policy creates? The very presence of Venezuelans' upside risk to supply, the knowledge that 303 billion barrels could, in theory, enter the market, is for the first time in a generation acting as a structural ceiling for global oil prices. And this is an intentional strategic outcome. It ensures stability for consumers, manufacturers, and small businesses throughout 2026 and beyond, which is a major domestic and global policy win for the U.S. The strategic goal isn't purely about flooding the market, which would be destabilizing. It is about shifting pricing power structurally. It moves leverage away from Middle Eastern and Russian suppliers towards this newly unified Western Hemisphere bloc, the U.S., Canada, Guyana, and now a conditionally integrated Venezuela. This shift fundamentally alters the geopolitical economics of oil, even if it inherently delays achieving peak production. Pricing stability for the consumer base is, in itself, a form of geopolitical stability.
It's a strategic success for consumers and for Washington's geopolitical aims, sure, but it remains a high-risk financial gamble for the Venezuelan sector itself. You cannot successfully execute a decade-long $100 billion program to rebuild decayed heavy infrastructure in the Orinoco Belt if you simultaneously and actively undercut the profitability of the companies you are relying on to execute that rebuild. The strategic goal, however admirable, is financially cannibalizing the long-term project.
So, to summarize my perspective, the current U.S. policy framework is necessary because strategic control, flow security, and demonstrable revenue stability have to precede the commitment of high-risk, long-term private capital. The implementation of escrow accounts and that geopolitical conditionality are successfully reordering the global energy map. They ensure that Western Hemisphere refiners and producers are the primary beneficiaries, and they provide the controlled, transparent revenue streams that are absolutely required to eventually fund that $100 billion recovery. Stability is the foundation for viable investment, not the guaranteed result of it.
And I would maintain that the Venezuelan oil paradox remains unresolved. The administration's immediate price suppression strategy directly conflicts with the technical cost and scale of long-term investment required for this high-cost resource. By balancing immediate geopolitical gains, gaining price leverage and shifting oil flow, against the cold financial reality of heavy crude extraction, they are risking a fatal profitability gap. And this gap risks leaving Venezuela's 303 billion barrels permanently underdeveloped, frustrating the stated long-term goal of 3 million barrels a day.
The interplay between sanctions relief, conditional stability, and global price pressure illustrates clearly that in the energy sector, no single policy objective exists in isolation. They are constantly, in direct tension.
And we're left to consider whether the undeniable geopolitical rewards currently being reaped outweigh the immediate technical and financial hurdles of this monumental decade-long infrastructure overhaul. The success of this policy now rests entirely on whether the private sector believes profitability will eventually align with strategic stability.
Factoring can meet the cash needs of energy companies looking to expand. Contact Chris at Versant Funding to learn if your energy client is a factoring fit.
Distributors can benefit from the quick cash that accounts receivable factoring can provide. Contact Chris at Versant Funding to get your client funded fast.
Processing companies can fund their growth using the cash accounts receivable factoring can provide. Contact Chris at Versant Funding to learn if your client is a factoring fit. Factoring can meet the cash needs of staffing companies looking to expand. Contact Chris at Versant Funding to learn if your staffing client is a factoring fit.